Hello and welcome to On the Rocks, one of the mining industry's leading podcasts, where we explore the future of mining over a drink of choice. I'm Jess, Prospector's head of new media, and I'm excited to introduce today's masterclass episode. Today, we are digging deep into one of the most critical challenges facing mineral exploration: uncertainty. Our guests are John Mern, the CEO and co-founder of TerraAI, who completed his PhD at Stanford's Intelligence Systems Lab, researching decision-making systems for large-scale operations, and Luke Ren, the chief of staff at TerraAI, who brings a unique investor perspective, having managed mining investments that returned over $200 million on $14 million invested since 2016. In this masterclass, John and Luke tackle the fundamental question of how AI can transform exploration from educated guesswork into data-driven decision-making. They'll explain why traditional uncertainty modeling falls short, how their approach differs from the flood of AI solutions hitting the market, and, most importantly, how better uncertainty quantification can help companies walk away from bad targets sooner and focus their budgets where it matters most. This conversation gets into some fascinating territory, from the psychology of risk-taking and exploration to why the mining industry desperately needs new types of capital, and how AI could help unlock institutional investment that's been sitting on the sidelines. So grab your drink of choice as Emily sits down with John and Luke to explore how uncertainty modeling could revolutionize mineral exploration. Take it away, Emily.
All right, Luke and John, thank you so much for joining us here on the Rocks. And I'm really excited that you guys are joining together in the same room. I think that might be a first, and I think that's awesome. So welcome to the show.
Yeah, thanks for having us.
Yeah, pleasure.
And of course, our first question is, what are you drinking today?
I am drinking a measure of Lefroy with a half measure of Lefroy. I like Scotch. The reason why this particular Scotch, I like really peaty, heavy scotches, and that is actually one of the first things that my now wife and I bonded over when we first started dating. We both really like, really kind of leaves no doubt in your mind that it is Scotch, and so kind of most of what we have in the house is just it's for Scotch lovers pretty exclusively. So yeah, that's my drink for today.
Yep.
Very cool.
I'm also drinking a measure of Scotch. Maybe this will earn me a kind of product placement.
Right? Yeah, that's what we're all looking for.
But yeah, I mean, the story behind that is like a lot of younger people. I didn't like Scotch initially, but then working in the mining industry over the years, at one point I was sent up to far north Queensland to a very small town there, where really you had pretty much two choices of what you wanted to drink: a mid-strength beer or a Scotch and soda. I've actually forgotten the soda part today, but I think that my former drinking buddies from Richmond in Queensland will appreciate it anyway.
You're gonna give us their names, you can tag them in it so they know you're thinking of them as you're drinking today. Love it. That's right. I got into bourbon because, much like what you were referencing, when I started working in mining, everybody drank Scotch and it was too strong for me, right? I just wasn't used to it. And so a good friend said, hey, give bourbon a shot because it's a little sweeter, but you can still be drinking brown liquor with everybody. So that's kind of what got me off and running. So today I'm drinking Traveler, which is Chris Stapleton's whiskey. It's really, really good, like the country musician. And I picked it today because I'm heading off tomorrow to Guyana again. So I'm like, it's always thematic. For some reason, I always want it as I'm heading off on a trip. So cheers, everybody. Great to have you. Great to have you on the show.
Absolutely.
Got to make the clinky sound, for the recording for everybody. So for everybody listening, we're doing this episode again as one of our masterclass episodes. So I really wanted to open up with a question for John. Before we dive into the actual technology side of this episode, could you help our listeners understand what are the fundamental challenges of uncertainty in mineral exploration? And why is it that traditional approaches often fall short? What goes wrong?
I mean, in short, modeling uncertainty is really, really hard no matter what system you're in. Exploration fundamentally is the practice of reducing uncertainty, right? So everybody that talks about why now, how do we get compute and AI into exploration, it's like, well, we have to start by modeling the thing you want to optimize, which is uncertainty. that, like I said, is very difficult. A lot of uncertainty modeling techniques revolve around either very simple distributions like normal curves and things that are not always appropriate to model big subsurface systems, or developed over decades of practice in fields like aerospace engineering, automotive engineering, financial modeling, things like that. And those models that have been really, really effective in uncertainty for those fields obviously don't transfer over to modeling all the things we're curious about in the subsurface. So fundamentally, if you think about it, it's just a lot of it just comes down to scale, where an aircraft you can effectively define, for some task with like 6 numbers. It's kind of kinematics, it's position and speed. For a mine, if you're discretizing it, modeling it reasonably resolution, you need millions and millions of parameters. So that's part of it. It's just a bigger, harder problem with a lot more uncertainty than an aircraft, for example, which is where a lot of these methods were born.
Oh, I didn't know that it kind of came from that space originally.
Well, I come from that space originally, so I might be a bit biased and over-crediting it as well. But yeah, I mean, a lot of modern AI and controls came from aerospace and similar fields.
Oh, that's fascinating. Well, and then for Luke, like from an investor's perspective, how do those uncertainties translate to business challenges and investment decisions? Where do you see those things interacting?
I think that really depends on the stage of the investment you're targeting. But I think overall, one of the biggest challenges for both the explorer or business and the investor to get their head around is kind of uncertainty of what the potential return is actually going to be. And then on top of that, it's and probably an even bigger problem in mining overall is the timeline of that return or failure. And I think those factors will speak directly to the ability of the explorer to get good bang for their buck on exploration decisions, and also raise capital, which I think a lot of explorers often raise as an issue. And then for the investor, obviously understanding those things is going to help them a lot in timing and sizing their investment position, and getting to a yes. I think that kind of the uncertainty on the resource is really driven by what's pretty often significant and very poorly quantified geological risk or resource risk. I mean, you may have promising signals, but what is the probability it's actually going to be an economic discovery, an economic deposit that's going to get funded into a mine? And then on top of that, you've got the long exploration lead times, and kind of continued capital raising requirements throughout that lead time, which is just going to destroy the return for both sides in that equation.
Yeah, I mean, I think adding to that, if you look at the data in the market, just the statistics and the reality of exploration, so many prospects are not fertile, they're not prospective, and that's okay. That's the geological reality of this business. But because investors have such a hard time distinguishing high risk and low risk, there's no kind of, if you look at any other asset class that people trade on, there's usually a pretty pronounced returns profile they can just quantitatively pluck and use. You don't have that here. So what winds up happening, and you can see this in the data, is that projects trade at a discount because there's no way to distinguish good from bad, and all the macros just say, hey, things are typically higher risk than explorers tend to advertise. So even good projects get traded at that same kind of painted with that blanket brush of trading at a discount to their apparent MPV.
Absolutely, a big adverse selection problem,
I
think, in the industry, which paints us all with a bad kind of brush.
Yeah.
Well, and I think to tag on to that, also, there's kind of an inherent misalignment, perhaps, in terms of, if you're raising money to do exploration. I mean, we all are familiar with the Lassonde curve. Most of our listeners are as well, right? But the times where it's easier to raise money it's counterintuitive. But when you know less about deposit, right? The more you know, the more you've, especially done drilling, the more you then also know that it's not the next world-class, whatever, tier 1 deposit, right? It might still be a really solid, fundamentally, important project to keep working on, but you diminish that blue sky potential, essentially, right? And I always say it's really similar when you're in the startup space, where it's like, it's easier to raise money pre-revenue than it is post-revenue, right? Why does that make sense? You know what I mean? But it's kind of a similar challenge.
Yeah. Oh, I've spoken a lot about the parallels between VC world and mining investment world. I mean, shockingly similar returns profiles, the risk return ratio, success rates, all of that. It is sort of the same thing. And I think psychologically, it's probably the same underpinnings in that kind of round dynamics situation as well. It's actually pretty prescient parallel for us.
Well, I think one kind of difference there that is interesting for us is that I think in general, your typical venture investments, people find it easier to diligence, frankly, because they're diligencing less. And a subsurface resource, a mineral deposit, can be very technically challenging to diligence. And I think that's also a place where, kind of AI tools can come in and help make investments more accessible.
Yeah.
Well, and how much do you all see on the de-risking side? Because my personal background is really, helping to run national scale or large scale early stage exploration programs, like at the country scale, right? And we're involved in one right now in Guyana. And I talk a lot to different stakeholders about the value of essentially pre-competitive data. And that what you're trying to do from a national scale or regional scale perspective is like lower that barrier to entry, right? So that you are lowering risk by providing more data so that folks can diligence things more, or you end up maybe with companies and teams that are a better fit for what you actually have in the ground because there's a little bit more known. Do you see that happening, especially on the tech side, where volume of data or type of data also helps you, kind of assess that risk better?
I think it can, but it's not a one-to-one thing. It's data is data. Data is not knowledge. It's not information about, it's not true information. It's typically a really noisy, incomplete picture of what you really care about. And we've plenty of examples of and it doesn't remove the moral hazard, right? You can point to any number of fertility indicators that you see in a data set to promote a site that you're now a part of or something else. So I think data is a tool and it's an input. I think it absolutely has the potential to do all the things you said, but it doesn't necessarily do that. And I think we've seen that, time and time again in places that have been data rich. Examples of good use of open source data in Western Australia. Plenty of examples of over promising and under delivering and other uses as well. So I think it's a really critical. Probably arguably the most critical layer to changing the paradigm here is the data layer. And the more I'm fully, wildly in favor of open sourcing all types of data. But I don't think it's the end answer, because I think ultimately what it will do is it will attract people to new sites. It does lower that barrier to entry, which is fantastic. Does it necessarily always guarantee the best players are at the right site? No, I don't think so. And like I said, it doesn't remove the moral hazard that is a non-trivial part of the bottleneck that this industry faces.
What do you mean by that? By the moral hazard associated with it?
Well, look, I go if you go walk the floor at PDAC or any one of these other places where juniors are selling their projects and asking for investment, there are plenty of times you'll come across projects that are advertising a geophysical signature or a drilling intercept is this great thing, but then if you dig into it with them, and especially if you're not coming across as an investor but just another guy talking shop, they'll go, yeah, we know it's nothing, but you got this signal and it'll help us raise the next season. Like that's going to persist, unfortunately.
Yeah, like this kind of the lifestyle company issue within the industry, essentially.
Yeah, and the parking on sites and all that sort of stuff is still gonna be there.
Yeah, I just never heard it called that before. So yeah, I'm gonna steal that.
Yeah.
Borrow. Yeah. Well, and so on that, I think part of what we're talking a little bit about is your first core solution area, and I wonder if you could share, like, how is AI making exploration campaigns more efficient? Because that's one of the big things in the industry, right? Is how we get from data to discovery faster, more efficiently, so more money is put on the projects that eventually can and should be built, as opposed to all of these projects that maybe have no real, chance of developing.
Yeah, no, absolutely. So like I said before, I think making better decisions, using AI to make better decisions requires the AI to have access to the thing you care about, which in exploration is uncertainty. So we think about where the most critical kind of layers or bottlenecks in uncertainty is or are, and build tools out to just really sharply quantify that and get it to be as tight, as precise as it can be, but no more. So I think one of the I say two problems that I think are pretty prevalent across this space with methods that do try to model uncertainty. One is just drastic incompleteness, right? There are some methods to do uncertainty quantification with drill cores alone, or you can get some uncertainty, stochastic inversions over one mode of data, but not two, maybe two if you're really advanced. But the picture that we end up at that actually models uncertainty is always fairly incomplete. That's one major issue that AI can overcome. ML models are the power, the thing that has made neural networks in the deep learning age what it is the fact that they are universal functions. They can take in principle, any sort of data and map any input-output pattern. So that's one thing that AI can do here is break the silos, make kind of uncertainty and modeling choices using as much data as you have. The other issue that I see pretty frequently with extensions to conventional methodologies is this tendency to kind of be a little bit hand wavy on how you do uncertainty, right? So we'll take our conventional optimization method that gives us one guess, and we'll just kind of put a cone around it. So okay, well it's probably plus minus 10 on this. That's complete horseshit. Sorry, am I allowed to swear on this podcast?
Yeah, of course.
Sorry, that's a horseshit method. It is one thing that everybody in the space knows is that the subsurface is really, really mathematical term would be degenerate, but basically that any given signal could have 50 different massively different deposits that cause it, or lack thereof that caused it, right? These methods that say we got one best guess and we're just going to kind of do a plus minus 50% around it is completely missing the most important sources of uncertainty. So, I think what AI can do here and what we're building to do is be really rigorous and honest with ourselves to provide a very objective and correct view that's as certain as it can be, but no more so, right? We want to do that. We want to use all the data that's available at every given time. And we also don't want to neglect the geologists, right? The geologists have a tremendous amount of expertise in every site they work on. Some of the teams we've worked on, they have thought about these sites more so than anybody else before in human history. And then so many AI methods go, yeah, but just give us your data, right? That's such a mistake. We want to be able to build the most feature complete system that can take in that geological expertise, take in the data, and then produce a model of uncertainty at the most critical juncture where that uncertainty is most important. And in my view, that's at the target screening phase, right? We see a lot of AI and ML solutions that are all about target generation and very broad scale sort of prospecting, basically, which I think is an important layer of the solutions here. What my view is the most critical thing is if you can get to screening decisions more accurately and more quickly, start shifting the amount of capital that we're spending on barren targets more and more into prospective ones, that's what really changes the game. We've talked to so many juniors and majors and exploration units, and what's really pressing to me is that when you start to talk to the juniors that are multi-asset, you start to talk to the producers and the majors that obviously have really big exploration portfolios, they're not asking for more targets. The thing that gets them really excited is, can you help me walk away from a bad target sooner so I can start spending my budget where it matters? Can you give me objective reasons for, allocating portfolios with confidence? That is, I think, the most critical juncture in exploration right now.
Yeah.
Just kind of getting that uncertainty model at that screening stage or at that target scale.
And what kind of data are you working with, especially for folks who may not be super familiar with kind of what gets fed in? What are the different data types that you ingest? Yeah,
so foundationally, we are data universal. Kind of going back to that ML state, we can in theory use any data that's out there. I say in theory because obviously we haven't done it with every single data source in the world. We've done it with all of your common geophysics, so all your mag, your grav, your EM, your DCIP, MT. And then we can, in the same pipeline, also add in your geological data. So your core samples, your logs, your assays, same thing with soil and pick points at the surface.
Mm-hmm.
And we can also, we treat as data, something I alluded to earlier, as geological mapping and hypotheses. So another data layer is this sort of soft data layer, kind of in decreasing softness, so to speak, of geological maps where we have observed and inferred geological features, very common, very important in a lot of these cases, as well as just, hey, I think this is the paragenesis of the site. I think this is what happened here, the sequence of events over history that led to what we're looking at. And maybe I have 5 or 6 guesses of what it might be. Me being a geologist, we can also ingest that as well. So we really do try to run the gamut. And when there's modes that we encounter that we haven't run before, it's a particular sensor system that we haven't run before, we can build up kind of on a case-by-case basis, because the foundational principle we're trying to get to here is always to make the next best decision on where to gather the next piece of data. And to do that, you need to have accounted for everything else you already know. So we always try to make sure we're data complete or feature complete in that regard. But yeah, it's geophysics, geochem, geo, kind of the broad gamut here.
And what kind of scale do you typically work at? Like in terms of the size of, is it like a regional geophysics, or obviously you're looking at target screening, so you're not quite at the project level.
Yeah, so we are at the project level. So most of the kind of screening we do is individual sort of project screening. So we are in this regard also fairly agnostic to the scale. We can layer on regional geophysics and tighter target scale geophysics into the same pipeline. That's actually fairly common because you almost always have some basis regional geophysics available in the projects we're working. And then it's just a matter of what we're trying to do. So if there's a strong anomalism already kind of identified by a team and they're screening between 8 prospects they've already pulled out, we would probably go through and model each one of those up at the meter resolution. So just compute wise, we're resolution limited. So if we're doing a 5 by 5 kilometer footprint at 5 meter resolution, we can do that, or we can go up to 500 by 500 at 10 meter resolution. So it's really just kind of the number of blocks in our model. That's the main limitation here.
Yeah, and I think you mentioned earlier something that I've probably shared on the podcast before, but one of my favorite geophysicists who works with us a lot always likes to say, I can make an anomaly out of anything. So don't ask me to, right? That's literally what you do with geophysics data, is look for anomaly, through all this. And so what I find fascinating about a lot of this stuff is that a lot of the AI companies kind of came up, I think it's almost like a natural thing. They came up out of the geophysics space, right? Because a lot of the kind of physics questions and the tools that you use, kind of naturally lend themselves to that. But that's where I wonder, how does this differ from a lot of the other AI applications in exploration? Because there's a bunch of them out there now. And of course, in general, because at Prospector, of course, we use AI too. And now I feel like everybody, I like to say, we were doing AI stuff when it was boring and nobody cared, right? You guys probably the same thing. Now everybody says they're doing AI because they've got ChatGPT built into a spreadsheet somewhere.
Yeah, exactly.
How does what you guys do in this approach, how is it different?
Yeah, I think saying you did it before it was exciting. That's I've been working in the AI field since 2016 when I first joined my lab at Stanford, and you've seen 3 or 4 different major waves of what's trendy in AI. When I first joined, it was competition between reinforcement learning. You had the first video game playing robots that were beating humans consistently, and then AlphaGo. And then it was computer vision for a while. And then it became chatbots, but then computer vision came back when they came out with DALL-E and synthetic imagery, and now it's everything is GPT, right? Yeah. So what's different here, right? So I think the first port of call for most people when you say, if you go to somebody, if I went to somebody 5 years ago, or you go to somebody now today and say, do the first kind of thing to do on mineral exploration, they're going to come up with one of 2 answers. One is anomaly detection. There's a whole class of methods called unsupervised learning that are fantastically powerful methods, and the whole job there is to pick out things that differ from background. So we've seen a lot of that. We've seen a lot of that in practice, both within big companies as well as from startups and other kind of lab spinouts and things like that. And they're powerful in that they will help, I think, apply human intuition at a really broad scale. But you still end up with the fundamental problem that Luke mentioned earlier, which is that you kind of just end up with this signal that is, there's something here. And more often than not, I've used these methods before in practice, and you end up running an anomaly detection or a clustering system over 5 or 6 different layers of your data, and you get an anomaly score for each one, and you say, okay, we're just going to sum those up, and this one's got a score of 10. Well, great. Luke is an investor. How do you invest in a score of 10? What is that? What is the risk profile of a 10 versus an 8? Right. So that's not really. So that's the first thing that I think is fairly common. And again, I think it's a very important level of the stack, but it's not really getting to that fundamental question of uncertainty. The second class of methods that somebody would come up with is regression, right? I have data, geophysics, regional survey data, and then I have some notion of where I found mines before. And I just want to try to train an AI to predict from data to mine or not mine. And there's a variety of reasons, technical reasons why that is extremely difficult to do well and to get to generalize. And when I say generalize, I mean like train it up in Western Australia and then have it work in Appalachia in the United States, as an example. There's a lot of technical reasons why that's really hard to do and why it has consistently failed, right? I mean, this has been tried before. I do think there are ways to make it work. Some of the kind of blockers for that are being solved by efforts like the regional and large-scale national mapping efforts that are coming out across the globe. But it's still a hard problem, and it still leaves you with that same fundamental issue, right? These are not uncertainty-based methods. And then I think the final thing, I don't want to go too hard into any particular company, but like AI is now a branding term as much as it's a technical term, right? Exactly. I'm sure you've seen plenty of companies that are suddenly AI companies overnight. I don't want to like hit on this too hard because there is no real precise definition of AI and whatever. But
usually you cut through that if you just ask them like, well, what kind of AI are you using? And then the predictive kind. I'm like, okay.
No, exactly. I always tell people just look at the people, right? Like modern AI is still really hard and still a really specialized field to build anything novel in. Like using it's fine. You can use anybody can use ChatGPT, but if you want to build something that ChatGPT wasn't purpose built for, or build a new type of AI, you got to have an expert on your staff. So if so is this a real AI company or what? Like what do you think of these guys? Go, look at people, right? So that's the other class of like AI that's out there is we took our conventional method and we added something to it, and now it's stochastic or it's randomized in some way. Again, not to say that those methods aren't powerful, but I do think there's a ceiling to how much they'll be able to do. That's probably a fair bit lower than starting from first principles and doing something from the ground up that's built to do what you want it to do.
Yeah, I think that, again, like John, my co-founder and I, we both started it. I'm going to date myself, but, we both started our careers at IBM back when, Watson was coming out, right? I was in 2004, and I think John was just a year after me in 2005. So it was like, I wasn't directly involved in it, but like this, it's hard stuff. And I think when folks are curious, first of all, the number one thing I tell people is like, be curious. If this is a business decision whether it's including AI or not is something that's going to change whether you work with a team or a company or use their product or service, like ask what kind. And if they can't explain it to you, I say it's just as the same thing I tell people about investing in mining projects. If they can't explain it to you in a way that you can understand, first of all, bad idea, right? Like if someone can't explain to you a project in a certain place and why you should put money into it and the geology and how it got there and all that stuff in a way that you understand, don't put your money in. And I would say the same about, AI work, right? It's no different than anything else because the folks that really know what they're doing can explain it to other people, right?
Yeah, I think the excuse that you hear a lot of that it's proprietary is bullshit. Like every ChatGPT OpenAI has published papers about what they're doing. Like plenty of companies. If your technology is you can replicate it by a 2-sentence description to a non-expert, it's not a technical moat. You're screwed anyway. So I think that anytime somebody says, "Oh, it's a proprietary system," I really can't get into it. that's a red flag for me as well.
Yeah, warning bell.
People looking up your research papers now, John.
Go for it.
Yeah.
They're on the website.
Exactly. Well, so then we chatted a little bit about, improving project screening. I think that's such a great thing to focus on, because I know a lot of the folks that I work with, even at that like national scale, it's like, how do you prioritize, right?
Yep.
How do you screen? How do you help make decisions? Because governments, mining companies, investors, everyone's trying to make sure that their money and their attention goes to things that are going to pay off. So how do you actually help companies decide which projects to pursue or abandon? Like, what does that actually look like in the day-to-day?
Yeah, so I think there's two layers to it, right? The first is just let's get them a model of uncertainty. You can get, when we say model of uncertainty, we mean a distribution over some parameter that you care about, right? Copper tonnage, for example. You've got 10 copper targets that you're looking at. Here's your returns distribution over all of them. Now you have a real asset portfolio kind of risk assessment that you can use in whatever kind of risk decision-making paradigm you want to. The other thing that is, so that's kind of layer one. Taking it a step further is a lot of the AI behind what we're doing. We have the fusion piece that's very kind of your generative deep ML model sort of approach to quantifying uncertainty. But then the so what of what you do with that uncertainty. My background was from self-driving. I spent a lot of time thinking about how to go from a set of cameras and radars and things like that to decisions that a human would make autonomously, or better, honestly, than a human would make in high-risk environments. So what we find is that what humans tend to not be great at is valuing information. To objectively put a basis on information that's provable, irrational in psychology and just general economics, So one thing that the other big piece of what we built is this thing about like a reasoning agent around decision making. And one thing that it's really, really provably good at, much better than humans in a lot of cases, is valuing information really rigorously and really objectively, which again, all exploration is collection of information. So in terms of prioritization, we can provide recommendations based on kind of forward-looking computation over, if you were to explore these 5 sites, what is the likely outcome and kind of what maximizes your expected IRR, MPV, or whatever it is that you care about when you're making your portfolio decisions to your boss, right? And again, coming from the aerospace and driving world, big part of that is being able to prove what you're doing is going to work, or at least not going to break too badly. So we built our systems to be very interrogatable and transparent, because people don't, and honestly shouldn't trust black box systems.
Right.
So being able to say, here's what the system recommends, and here's why, and here's the expected returns profiles, and here's kind of some what if scenarios of what might happen if you go down XYZ route. Also is kind of how we can help companies break these bottleneck decisions, or make kind of decisions from the very high level strategic down to the more tactical, like where do I, send my drill rigs, where do I permit my pads, et cetera.
But how much, like psychologically speaking, I always find it interesting how it's sometimes easier to talk to people about making good decisions than it is to keep them from making bad decisions, right? Like everybody wants, there's this whole, because I worked around and, with the military quite a bit, and my husband's former military, a lot of special operations folks. And one of the unique things about that community is the focus on the bad decisions, right? Like, let's not let the worst thing happen, obviously, right? And let's plan our way out of that. Whereas in a lot of other industries, I find, including in mining, there's this inherent bias to look for the best decision. When in fact, depending on where you are in the decision-making process, just eliminating the really bad ones would be a huge improvement.
Yeah, I mean, look, that's so we also do some work in the reservoirs world, and one of our first and biggest customers is a legacy oil and gas producer. We're developing a large-scale offshore project with them. That is their way of thinking, is how do we make sure, safety standards and monitoring standards are all really rigorous there. So how do we prove to them that we can improve their economic targets while also having really, really high safety? So that's, again, good transfer from the aerospace world. But I completely agree with you I think that kind of going back to this adverse selection problem we talked about earlier, explorers are in it because they are higher risk tolerance people. It's my kind of very kind of
optimist.
armchair psychologist. Yeah. Yeah, I mean, but they are like you don't get into an industry like that unless you want the big risk, big return. So I think there is part of it is adverse selection and psychological, but I think you can. We're early in this, right? We're still learning how to communicate things in a way that's compelling. I think there's a lot of very basic things you can do in the messaging. There's framing something as you're going to lose out on this opportunity versus you're going to kind of potentially gain this extra thing can often be subtle but compelling way to communicate. I think it's the same games you play in like any negotiation around like, how do I communicate this in a way that's really going to hit what they're looking for? And risk-seeking behavior is kind of a flip of that. I also started my career in defense intelligence. That's where I spent a fair bit of time before coming over to this world. So it really resonates what you said. But yeah, it is a different, very different mindset.
I would say it's like the difference between if you're young and you're dating, between asking like your best friend's opinion when you're going out at night on potential matches versus the future mother-in-law's opinion, right? Yeah. Like one of you is looking on one time horizon.
Yeah.
The other perspective is looking at the long term and a whole bunch of different factors, right? So I think we underestimate in mining sometimes how the psychological aspect of that visioning, right? Especially on the explorer side. And I love them. Like I love all my friends in the junior space, and we wouldn't have a pipeline without them. Right. And in order to put yourself in that space where you're going out into the middle of nowhere, looking at rocks, thinking you're going to build something out of it, you have to have that mentality. Right. But it does, I think, come in when you're coming into that screening process. And this is where I 100% see the value of how can you cut out some of that bias throughout it.
So going back to the VC analogy, right? I think one of our lead investors' one of my favorite quotes of his is investors are motivated by fear. Like their two motivations are fear and fear, right? Fear of missing a good deal, fear of making a bad one. But I think that what you see expressed in VC world is that once a respected firm signals on a deal, everybody else in the space piles in. I think that'll be kind of one of the unblockers here in the mining space too, is that once you start to see success, kind of real undeniable success around an exploration mode or a new technology or whatever else, it's going to have that follower, because I think that you're going to have that same fear of missing out on a trend that's going to put you behind. But we need to do it in a way that's both like, hey, it's success, but it's also understandable success, right? I think companies that are coming out here and saying, hey, we used AI to make XYZ claim, we make XYZ discovery or do something else, but they can't explain how or why or how somebody else could do it. It's like, there's kind of a so what there.
Right. You don't know if it applies to you, right? It may not work for your company, your project, if you don't understand that. Yeah.
Or there's a skepticism. I think people are skeptical of black boxes. So when you see.
Well, and on that, so Luke, over to you. Like we do have a lot of investors who listen to the podcast, and a lot of them are frankly like new to mining, or they're interested in it, but they are kind of trying to find a way in, right? It seems to be tougher than other industries for folks to kind of think of how they're going to come in and write their first check. So from your experience, both as an investor and now working with TerraAI, how does the approach like that you all are using change that investor conversation around the exploration?
I think I'd like to answer that on a couple of levels. So the big vision, one of the two big visions related to that, I think, is that AI can really help unlock capital. And John kind of alluded to this by saying, when we show some success and everything, we make the entire industry seem less risky. But I'll also add to that, exploration investment, my experience, is often quite expensive to diligence, quite technical to diligence. To deploy what, frankly, at an institutional scale, are pretty small check sizes, especially into earlier exploration. And even though the potential returns can be very attractive in the context of an institutional investor, where like most of the capital in the world lives, that equation often doesn't work. So I think one of the reasons here is by making the initial screening, project level screening, more accurate, more fast, and cheaper, you can actually unlock a lot of capital that really wants to deploy into the industry, but just can't kind of make that equation work today. And then yeah, and obviously a lot of what John's already said kind of feeds into that. Instead of having a kind of, there's something here, and maybe there'll be a return in X number of years of this amount if everything goes well. You can actually kind of go from, the sophisticated investors will probably have some expected value calculations, but actually going from that and according it back out into a probabilities profile on the geological risk. Okay, there's a 10% chance that we have 200 million tons of 1.5% copper. There's a 10% chance that we actually have a much smaller resource than what we think today. All of that will really help investors understand what their downside and upside risk is. And then on top of that, I think another kind of big concern is on timelines and uncertainty of future capital, or meeting future capital requirements.
Right.
Another way that AI can make the industry a lot more investable is by speeding up that timeline and reducing that dilution and having a more effective exploration spend. And then on top of that, a big concern for investors is always going to be like, am I going to be able to sell this, or am I going to be able to find the capital needed to develop this mine? With the AI tool, the hope is that by quantifying all of these risks, you're actually making not only your investment decision, but the follow-on investment decisions a lot better and a lot easier as well. And then, so I think all of that really speaks to bringing more capital into the industry. And then I think the other big vision that we have here is I think what we're trying to do is raise the value of the entire sector. So to kind of throw a hypothetical at you, if firms like TerraAI can help you speed up your exploration timeline by saying 40% today, and we're hoping to make that a lot better, but speed it up by 40%, reduce your exploration spend by 40% commensurate with that, because you don't need to waste a lot of money on barren targets, and then just show some marginal improvements in grade. Say you go from 1 gram a ton of copper to 1.05 grams per ton of copper, and then also maybe increase your resource size marginally as well. So you're going from a 20-year mine life to a 3-year mine life, 25-year mine life. Then theoretically, if the market accepts all of that, for the typical mining project, you'd see you would expect to see something like a 3x increase in valuation of a junior mining company. By kind of year 5. And
I think the risk discount in the market here is. Even when you're selling at DFS, it's a 40% risk discount on average. So you're selling at 60% of your NPV. So I think everything Luke said is just like the on-paper objective. Here's the projected thing. I think and if you can show that you did it with rigorous methods and that the handedness is a bit lower, I think it's even higher personally.
Absolutely. But that's without even talking about the risk discounts that people apply in their minds at all, right? And that's probably the even bigger lever. But I'm a pretty conservative guy, so I like to stick to stick to the numbers. But just on kind of those conservative numbers alone, you go like 3x increase by year 5 of exploration for a typical project, and then even after exploration's over, just on the improvements in grade and everything alone, you'd expect to see an 80% kind of increase in value of your typical project. And again, that's without changing the applied risk discounts that we're talking about here. If people go from saying, okay, you've got your discovery, that's nice, we're going to whack a 5%, a 1 to 5% on your NPV to value your company now, because we don't know about whether we're going to be able to raise money to build it. We don't know if your resource models are accurate. Well, if you change that from 1 to 5% to more like 10% or 15% or even 25%, I think is not unreasonable to expect. That still leaves a lot of upside for all your follow-on investors. That will be huge for the exploration industry. And I think that'll give the exploration industry a value more commensurate with what it actually contributes.
And I'll talk as the idealistic startup founder instead of the investor perspective. I was actually talking to another founder in this space who's building a very different tech stack, very different phase of the problem. But we had the same fundamental kind of thesis of like, hey, why did you come into this space? And he talks about like, oh, you can de-risk this, you can de-risk that, blah, 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 blah. But his punchline was the exact same of my first pitch was, and if you de-risk it, you make a lot of metal that wasn't economic, you bring more metal to the market. That's fundamentally, I think, the truism here that we're all chasing coming in from other industries, right? Nobody's coming into mining and minerals exploration from the tech world because they couldn't find an equally or better, more economically attractive opportunity in tech. We're coming in because there's something about that macro mission that is also a driver here. that again we're all recognizing the warning bells going off and wanting to contribute in some way as well. But I think tying it back to Luke's kind of point here is like, you make the economics per project better, you make more projects economic, you make the macros better, and the whole industry accelerates.
Yeah, I mean, I'll make a sweeping generalization here. Institutional investors, the mining industry is full of amazing opportunities, really asymmetric returns. I think, probably better than almost any other industry out there in terms of the opportunities that are available. But your typical investor at an institutional level is not looking for that kind of, if I get, one in a, if I hit that 1 in 100 companies, that's going to generate a big return, then I'm going to do well. They're looking for industries that overall reliably generate a return.
Yeah.
Right.
Sure.
So I think that's a way, the better screening component of what we do here, I think could be a huge contributor to that.
Yeah.
I think that's super exciting, because one of my kind of pet peeves is that folks within the industry, raise money from the same places over and over again, right? And I think it's created this issue where it's not that we don't have good assets out there or good teams to develop them and run them. It's that the financing structure for the industry is over. Like, we need a different business model, and part of it is we need new kind of non-traditional mining capital to come in, and you can't do that if you're still talking about projects and companies the same way you always have. Right.
Yep.
And folks these days want data, and they want different types of tools like what you all are talking about that helps them make an investment decision that's different from how the same dude, in Toronto has been financing mines for the last 25 years. Like, it's just not going to work. And so I think that's what's so cool. I can totally picture what you all are talking about, convincing somebody to write their first check in mining. Right.
Yeah.
And I think that's really, really powerful for folks to think about. We've got to tell stories differently. We've got to provide data differently. And you have to do that by also working with folks who haven't just spent their whole career in a traditional mining industry space, right? Because it just makes it much harder to get out of the bubble.
Tying it back to kind of uncertainty, the topic of the masterclass here. Luke has already said, like there's evidence of alpha everywhere. There's tons of it's a very right-tailed distribution, tons of lopsided returns. The thing that I think scares away investors here isn't even that it's very high uncertainty and very high kind of risk-return profile. It's that they don't know how to measure the risk. In almost every other real asset, you have a risk metric that you can reliably apply, and you can apply your same investment thesis as you would in any other asset class. I think establishing an uncertainty quantification methodology that is objective, consistent, and will provide apples to apples comparisons across assets is the thing that's missing here. Hopefully not missing for much longer, but is the thing that it's less about saying, hey, we can generate alpha. Yeah, okay. How am I going to know it before everybody else is the thing that every investor wants to know. And there, it's just if you can extract a higher signal to noise, or reduce your that kind of denominator in your Sharpe equation there, like what I think is going to bring more people to the market, allow them to apply their typical thinking and their patterns that they're comfortable with and confident in to this space, which right now they can't do. So I think it all hinges on uncertainty.
Well, and I think especially having some specificity around the definition of uncertainty and how it relates to the potential for eventual production, right? Which I think is, again, very different from how the industry has operated for the last several decades, where there's a lot of money that's made off of raising money and doing work on projects that are not likely to ever go into production, right? And I think a lot of the bigger picture geopolitical and strategic questions that we talk a lot about here on the podcast, we need metal. Like, we need stuff to come out of the ground to make all the stuff that everybody needs for all the things that everybody wants, right? And so in order to do that, the industry also has to shift and really start paying attention to, this capital wants to come in and build mines that are going to mine stuff and make stuff, right? This isn't just a stock promotion exercise. It's not a pump and dump scheme. Like, we've got to kind of acknowledge that has been a big part of the industry, and the uncertainty is different, right? The uncertainty of, can I raise more money in a year for this project? It's a different level of uncertainty than, can this mine or can this project ever become a mine that will develop things that the world needs?
Yeah, I mean, mathematically, there's this notion of variance or uncertainty propagation, and basically it's capturing the idea that multiple sources of uncertainty combine to generate the uncertainty around one thing that you really care about, like the economics of a mine. So you have geopolitical, you have financing risk, you have all sorts of other risks that kind of feed into that propagation stream. But one of the things that's maybe, people tend to think about that sometimes as like a summation, like, oh, this plus this plus this. The reality is
above ground risk, below ground risk, and those are the only two things we need to get to. Yeah,
exactly. But the reality is that there is upstream risk that's not just additive, but multiplicative or exponential downstream. So higher geological uncertainty, which is usually the thing that underpins everything else, drives capital risk, capitalization uncertainty, drives financing uncertainty, drives all these other forces of uncertainty. So while, it might be, it already is typically one of the biggest sources of uncertainty in a kind of as is analysis today, but by cutting that in half, you might not just cut that piece in half. You might also take all these other downstream sources of uncertainty that it's being propagated into and reduce them as well. So I think that's something else that's like, you think about what the biggest source of uncertainty and the biggest driver of risk in this space is. Geological uncertainty is irreducible. That's the thing you have to get away. Like you can't fake your way out. You can't mitigate that. It's there or it's not. It's extractable or it's not. That has to be understood. Everything else, I don't want to say everything else, but that's the thing that underpins things. It's that you can't get away from.
Yeah, and I mean, it impacts pricing, right? Like, because depending on the level, the technical risk impacts whether it actually comes into production, what grade it comes out at, the products that are generated. That impacts how the market's going to react, right? Which affects pricing, which then means all sorts of other things for every other similar type of project within. And
I'm glad you said pricing, because if our grand vision, of not just us, but everybody else kind of working to innovate this space can be realized, we react faster. We go from discovery to mine faster. We're more reactive to commodity cycles. And then we don't have these killer trough peak cycles that people are, again, pricing risk is huge, right? People are pricing risk all over the place. That becomes less of an issue too. So like, it's just, there's so much ripple effect here.
Yeah, absolutely. We can compress the cycle. I mean, you mentioned having a lot of new investors listening to this. Most of the commodity cycles in this space are literally just driven by the time it takes between the price to be high and the time it takes to build new supply.
Yeah.
If you compress the time it takes to explore and develop that new supply, then that would be transformative for the valuation of the value of the industry.
Yep.
Especially with everything going on with, battery metals, critical minerals, I also worked on rare earth projects before anybody gave a shit, right? Like a carbonic height in southern Afghanistan. I'm having to explain rare earths, the Pentagon. It's now it's everybody talks about it. Everybody knows what they are, but it's there is this huge disconnect between the pace at which the world is developing new technology that needs new types of metals and minerals and the time it takes to find them and build the mines to produce them, right? So we can't keep having all this amazing, low carbon economy innovation and not be able to pivot and supply that stuff faster and easier and cheaper for everybody.
When I first got into this space, I was at a barbecue in Silicon Valley talking to some guy that was, let's say, roughly speaking, matches every Silicon Valley stereotype that's out there. And I told him I'm in mining, and he said, "Oh, that's awesome." And I was immediately skeptical. I said, "Well, what? That's awesome." And I kind of paused for a second. It's a Bitcoin or Litecoin or whatever the crypto of the day was. Yeah. Bitcoin or Litecoin. I go, "Oh no, metal mining." He goes, "Oh, that's." I go, "Well, what do you do?" He goes, "I'm in advertising optimization at Facebook." I'm like, dude.
Emily, John got a swear word out earlier, and I'd like to match that. You mentioned earlier, essentially everything in the world is either, mined or grown. So, sorry to everyone listening, you've heard that one before. I've got a different version of that I really like from Australia, which is called, say, ban mining. Let the bastards through the dock.
I grew up in rural Maine, which is a big forestry state, right? And driving around my part of Maine, and you would used to see bumper stickers if you don't like forestry, good luck without toilet paper. It was one of those things. So it's I totally get it, but I think it's, I also find it fascinating though, because I do feel that's shifting. Even, I will say, like, I pitched on Prospect to at least 100 VCs, mostly out of Silicon Valley, New York, right? The big hubs. Only, I think 3 of them had ever talked to a company that had anything to do with rock mining before.
Yeah.
But I would tell our colleagues, I was like, that's as much on us as it is on them. Because if our folks aren't going out there talking about the cool stuff that we do, why aren't you pitching VCs on all of the stuff that we do in the mining industry, right? Like, we can't expect people to know about what we do and appreciate it. We're not going out and putting ourselves out at those cocktail parties and going to different conferences. Like, if we're just all moving from one mining conference to another, talking to the same people we talk to on the conference circuit, like, and don't come bitch and complain to me about nothing ever changing, right? Like,
even in the last 2 years, it's changed, I would say, from our first fundraising motions, 2023 to late 2023, excuse me, to now. Every conversation I had in that first round was education. 90% education. What is mining? Why copper? Why this? Why that? And now it's kind of like, everybody has I'll say naive, but they've read something.
Right.
They know what mining is. They don't have to be convinced that mining is a thing that they should be paying attention to at the very least. So the bar is incredibly low, but at least it's inching up there. It's nice to see.
Now I think the challenge, the bigger misconception that we're dealing with is a lot of the generalists that are getting excited about mining are assuming that a lot of the problem is on identifying new targets, identifying new prospects, essentially. Whereas I think, hopefully you'll agree, Emily, that a lot of what we're interested in doing is actually around, speeding up the kind of existing pipeline of projects. Because, as an investor, frankly, the last thing I need is more potential prospects to go and spend exploration money on. It's about unblocking the actual downstream.
And it's ironic because the one question that every investor invariably asks in the VC side is, what is the actual payoff cycle like this for? If it takes 15 years to go to mine, why would I invest? Well, it's triple my mandate.
Right.
Yeah, I understand. I hear you. That's
No, and that's what I mean. The other thing that we constantly get, because prospectors also in the mining tech space, from really more of like a data company, right? But they put us in with mining tech, and they're always like, oh, the whole industry is smaller than the market cap of Apple or Tesla. Like, why bother, right? Like, it's that typical, like, how do you get to a unicorn if you're working in mining? So but again, that's on us to broaden the scope, right? Because we're certainly not the only industry that's ever gotten that kind of stuff. But I think on the uncertainty side, that's where, I think, to your point, it's as much uncertainty about where is the industry headed, where does the industry fit in the larger global perspective, and how do you take that into account, right?
I think there's a tailwind there right now, though, I think, which is nice, in that almost everybody's predicting shortfalls, which means pricing pressure, which means upside for early movers. So right or wrong, I think that's the general perception in the investor space. And I personally do think it's generally right. I don't think it'll persist across every asset, especially to the degree in which it's being advertised in some places. But I do think that's generally correct. And quite frankly, a lot of investors are investors in some of the companies you mentioned, or in companies servicing those companies. And the big fear report right now is are we going to be able to build more data centers? Like, are we going to actually source the power and the supplies for that? Like, I have 20% hold in this AI company. How they can't get GPUs? How is this going to get worse? So I think there's more attention upstream, rightfully so. And I think it's not unlike a lot of trends in VC and other, say VC, I'm picking on that because I know them, but like unlike other trends, this is not ephemeral. Like, this is something that's going to persist at the time scale of mining. This is going to be here for decades and decades, for better or for worse. So I think it's something that's going to be paid attention to for a long time. Because it's small relative to the market cap of Apple, you can say about most nations.
Right.
So you can about that, right? The reality is it's a white space, and investors love early movers and white space and growth potential. Same reason why you have the Lassonde curve. You have that here in investment land. So I think it's a tool that we should use, and something I can say is a tool, not like, oh, it's a trick or something. It's the reality. It's the on the ground reality that's going to persist for decades to come. And the more you educate people on this, from new investment classes, the more you'll pull in, because it really does. I'll go to my biased opinion again. If you can teach them how to think about it and think about the things they care about, which are returns and risk, it's got everything else they want.
Yeah.
So I think it's really worth it's worth doing the work to socialize it a lot more.
Yeah.
In the right ways.
And like you said, Emily, it's up to us as an industry, I think, to communicate a lot better, because I mean, we could do a whole other kind of class on all of the horrible pitches or horrible corporate decks that we've seen, where it's frankly the same story, or I think the most egregious, and there's a lot of, frankly pretty egregious ways of trying to promote yourself that are pretty common out there, that just turn off a lot of investors who really, focused on the upside here. A lot of people really want to invest in mining, in my experience. They just don't feel that it's accessible.
Yeah, and to be fair, it's not.
Yeah.
Like it really, like if you're not an expert at diligencing mining projects, don't get into mining investing in juniors.
Yeah.
And then your options are what? The majors, tech companies. Like you can do, that's the way to go. But like a whole different class of investor that's interesting, being a little bit more on the alpha side. So
absolutely. Yeah. And that's where AI, I think, can really help with not only quantifying the risk, but also just communicating it in a much clearer way to people.
Yeah.
And making it understandable by a wider audience.
Yeah.
Well, and I guess that's where I was really excited. A little while ago, I went out to Stanford to speak at a battery metals innovation workshop type thing. So like, we want someone from mining to actually explain where all the stuff comes from. I was like, okay, like, can you do like a half hour, like mining 101? Yeah, no problem. I opened it with like, all right, everybody, first of all, there is no magic lithium fairy. There's no magic cobalt fairy. There's no magic copper fairy. Like, it doesn't just show up the way it used to, right? Because you need a whole bunch more of it. But that's the reality, is I think folks are, as you're saying, like, folks are waking up to the fact that this stuff is made out of real stuff that comes from somewhere. And all of these other things are dependent on that stuff showing up when it needs to, right? And so how do we talk about that? And it's not just if it's not growing its mind, like, stuff. Like, we have to have real conversations with people who are making real decisions so that we can kind of integrate the de-risking into these larger pictures. So yeah, absolutely. We solve all the world's problems on this podcast. So
that thinking persists down the line too, even into the mining industry itself. Of like, well, we'll just continue to increase capacity utilization. It's like, no, we won't. We're at an average like 0.5% head grade in copper. Like, we're not going to go much further than that. We're at 95% capacity. Like, we're not doing better. You have to do new stuff here. That's that's college itself sort of thing.
I think BHP is saying that existing copper mines are going to be producing about 15% less by 2035 in their projections.
Yeah.
I mean, how do you scale that? How do you scale up that base if the resources deplete? Right?
If you do the math on it, if you produce if the head grades continue to decrease in the same rate they've been for the last 15 years, to hit demand in like 2040, we're going to be producing as much ore every year as we have in all of human history up till today. Not till like 1990, to today. Every single year, is the head grade. That's such an exponential effect that demand and anyway.
Yeah, it's just it's hard to, I guess, to wrap, because I think we could talk about this for hours. To kind of close it out on that note, so if you guys could leave someone with one piece of what they should really understand about facing that headwind of where we need to get to and where we are, should they really understand about uncertainty in the context of that problem set?
I'll give my opinion. I think the thing to understand in the context of the impending metal shortage is that we likely have enough capacity in the pipeline. Right? There's hundreds of millions of tons of copper, for example, in the pipeline today. The trick is telling what's good from bad and actually being able to pick out the winners and losers. Because for every ton of copper in an economically viable deposit, there's probably 10 or 15 other deposits that look pretty similar to it that have nothing. So in the terms of uncertainty, I think being able to distinguish as early as possible where that 100 million tons is and where it's not is the key to hitting any sort of realistic, like timeline relevant change here. Like if we want to actually try to hit the demand, the 2040 demand projections or and beyond, that's the way to do it, is to really just try to understand good and bad as quickly as possible.
Absolutely. And Luke, how about you? Any thoughts?
I learned on John's words.
Copy paste. Yeah.
We've talked about it so often that I think we're probably mind melded at this point.
Yeah.
But yeah.
Well, awesome. Well, thank you both so much for coming on and sharing with everybody your thoughts on it. And again, I think it's such an exciting space, and looking at it from super early stage all the way to kind of the project scale. I'm so excited to see how everything you guys and the other folks working on this problem set are going to help change the future of the industry. So cheers to that, and
Cheers.
look forward to being in touch and hearing how it all goes.
Thank you so much for tuning into this episode of On the Rocks. If you enjoyed today's masterclass on uncertainty in mineral exploration and want to learn more about how AI is transforming the mining industry, be sure to check out our other episodes featuring cutting-edge technology and industry insights. If you are interested in being a guest or sponsoring an episode of On the Rocks, please email us at media@prospectorportal.com. Until next time, I'm Jess from Prospector, and we'll see you for another round of On the Rocks.